Topic: Profit or loss and financial position. How does a business measure profit or loss? An accountant prepares an income statement for a business to show if the business is making a profit or a loss. What determines profit or loss? The profit or loss is the difference between the total income and the total expenses. When is a profit made? A profit is made if the income is higher than the expenses. When is a loss made? A loss is made if the income is lower than the expenses. Why is measuring profit or loss important? The information provided by financial statements shows the owner what has happened to the business during a certain period of time, usually a year. It can be used to monitor the progress of the business. What happens if a profit is made? If a profit is made, the owner is making money on their investment. What happens if a loss is made? If a loss is made, the owner might have to make changes to the business. How does a business measure its financial position? An accountant prepares a statement of financial position to show assets, liabilities, and capital. What are assets? Assets are things owned by the business, for example, premises, inventory, motor vehicles, money in the bank, and amounts owed to the business by other people or businesses, for example, money owed by credit customers, called trade receivables. What are current assets? Current assets are short-term assets that the business intends to liquidate within a year, for example, trade receivables, inventory, money in the bank. What are non-current assets? Non-current assets are long-term assets that the business intends to own for more than a year and are not easily liquidated. For example, premises, motor vehicles. What are liabilities? Liabilities are the amounts that the business owes to other people or businesses. For example, bank loans, bank overdraft. What are trade payables? Money owed to credit suppliers by the business is called trade payables. What are current liabilities? Current liabilities are short-term liabilities which the business intends to pay within a year. For example, trade payables, bank overdraft. What are non-current liabilities? Non-current liabilities are long-term liabilities which the business intends to take longer than a year to repay. For example, bank loans. What is working capital? Working capital is the amount of money a business would have left if it converted all current assets into cash and paid off its current liabilities. How is working capital calculated? Working capital equals current assets minus current liabilities. What is working capital used for? Working capital can be thought of as the capital available for day-to-day trading activities. What is capital, owner's equity? Capital is any resource provided by the owner to start up the business or keep it going, also called owner's equity. What forms can capital take? Capital is often money but may also be buildings, furniture, equipment, motor vehicles, goods, etc. How does profit or loss affect capital? If a business makes a profit, its capital increases. If it makes a loss, its capital decreases. What are drawings? Drawings refer to when an owner takes assets from the business for personal use, for example, money, goods, motor vehicles. How do drawings affect capital? If the owner takes drawings from the business, the capital decreases. Thank you for watching. Make sure to like, share and subscribe to flashcards and turn the bell icon for future updates. See you in the next video.